Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is J. Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's program is sponsored by Building Insurance and Risk. Don't put your real estate investment at risk. Work with Building Insurance and Risk. Receive multiple coverage offers with a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Dale Watchowski. Dale is the president, CEO, and COO of Redico. Dale has more than 30 years of real estate experience in both local and national platforms, with a diverse spectrum of expertise in acquisitions, development, capital markets, and operations. And in just a minute, we're going to speak with Dale about trends in commercial real estate development. And but first, a quick reminder: if you like our show, CRE PN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We'd love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Dale Watchowski. Welcome to CRE PN Radio.
Thank you, Darren. Nice being here today.
Well, I appreciate you doing this, and I'm looking forward to our conversation. Before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Sure. I'm, as you noted, I'm the president, CEO, and COO of Redico. Redico is an acronym for Real Estate Development and Investment Company, and that describes very well what it is that we do. We develop and acquire real estate. We also happen to be a full-service real estate company, so we operate the real estate that we own. We do very little third-party work. We do some for strategic clients, and but for the most part, we're engaged in our own business as it relates to management, leasing, operations. My background is that I've been in the business about 40 years. My start in the industry came through Travelers City Group, went on to HSBC from there, and then finished my institutional stint with JP Chase. So I'd say that the first half of my career was on the institutional side of the business, investing on behalf of institutional companies and large companies, and then went to the dark side about 20 years ago and started investing for my own portfolio. So that brings me to where I'm at today at Redico and its affiliated companies.
Got it. So Redico, was it 50 years it's been in business? Is that?
Yeah, Redico's been in business for just over 50 years, actually. And we're a Michigan headquartered business doing business throughout the country. We do have geographic focuses, and I can share those with you. But we have been in business for just over 50 years, and I came on board 20 years ago.
Got it. I'm curious, the asset classes you guys are in today, as opposed to when you started with the company 20 years ago, is it the same? Has it changed?
Yeah, that's a great question. We've changed considerably, and we continue to change. And I'd say that that's a key to our success, really. I came on board with the passing of our founder. I left my last job at JP Chase and decided to build a business investing for my own portfolio, and I spent 5 years doing that with a gentleman by the name of Michael Kajoyan, and from there, I came into Redico 5 years later. Really quite unexpectedly, the founder of our company, Bob Sosnick, had passed away, much sooner than anticipated, and died young, and the family was looking for someone to run the business. So our business, and to answer your question, at the time was largely related to office, and we were developers of high-rise office buildings. We had essentially one primary partner, and that was Teachers Insurance and Annuity, TIA CREP, out of New York. We were also involved in the sports and entertainment business through a company called Palace Entertainment. Many knew us for that business, and the Sosnick family brought me in to run the business, and so we've changed considerably, from that time on, and established much less of a focus on office, and establish a focus on other asset classes along the way.
I'm curious on the office. Clearly the talk of office occupancy with the pandemic and stuff. How do you see your inventory, your portfolio? Have you seen a dramatic change in the occupancy or the use of office space? Have you guys been affected by that?
Yeah, another great question, and another reason why we became reliant on a diverse grouping of asset classes. But yes, we have seen a lot of change. Fortunately, it hasn't translated to much of a change as of yet in our occupancy levels, for our office portfolio, because we're still very active. But what we've seen is certainly a shift to Class A properties, which we are the beneficiary of. All of our office buildings are A properties in the markets that we operate in, and so what we've been seeing is that tenants are using this opportunity to trade up. The other factor is that all of our tenants right now are trying to figure out what they want to be, going forward, and it's no surprise that we still haven't settled on the ideal work environment. Are we remote? Are we a hybrid? Are we back in the office? And we chose here at Redico. We've been in the office since really as soon as the government let us back in. The state of Michigan was very restricted, but following the pandemic, we came back to the office, but we have morphed into a hybrid work environment. But most of our team members are here, and so much like what we're doing, our customers are trying to figure out the same thing. What's also happening, and it's happening here, is that our tenants or our customers are trying to determine how to use their space. If you have a hybrid work environment, then hoteling makes a lot of sense, and many of our customers are moving to hoteling, and actually are providing desks for their team members, but that desk could change from day to day based on who's in the office. And so what it's translating into is generally a reconfiguration of the space. And it's also translating into, in many cases, less use of space. And so it's kept us on our toes, and certainly it's caused for some interesting discussions.
No, I can only imagine. I'm kind of curious, as you were talking about that and kind of the hoteling of the office space. And I know the companies that we work with that have some sort of configuration with that, where they're basically have people sharing a desk depending on when they're going to be in, kind of thing. Have you seen any, or is it even a thought as about how you can reconfigure or not reconfigure, but even like change some of the occupancy? If there's a couple of floors, I was just thinking, like, if you have people coming in to work, if they've, are working more remote, but they're coming in, is there not like a housing thing to where you could have like even a hotel operate on a few floors? I mean, it just a thought that entered my head. Not that I have there's any substance behind it, but it just occurred to me that some of those premier sites, if that, I don't know if that's even a thought or even an option or even a consideration.
Yeah, everything's open for discussion, and what we're trying to do is find creative solutions. Even before the pandemic, our response to changing market conditions was to offer the best level of service to our customers that we could. And by that, I mean we wanted amenities within the building. So premier food service. We added conference rooms. We added cyber cafes. We added fitness centers, and all with the idea that that our customers would benefit by being in a Redico property. I'd say that today the benefit of having those amenities in the building is really that in most cases, and when I talk to the guys and gals that are making decisions, in most cases they're making decisions around their space that enables them to attract their employees back to the office. And most of these folks that are making decisions are actually doing so with the thought in mind that they do want their team members back in the office. And I think there's a consensus, at least amongst the customers that we have, that they would like to see their team members back at work. So what that means is that you're going to have to offer amenities in the building, but you're also going to have to serve that employee in a different way. We started early on, in an effort to bring people back and keep them safe. We started by bringing in lunches, and so during the pandemic, of course, we didn't want to gather in a common area, and so what we did is allowed team members to order a lunch, and we'd bring it in. The idea was that we didn't want them going up and down elevators and walking through common areas in a building. Now that's changed a little bit, and we're not offering the lunches, but what we did do is built out what we call a hub, and that hub is a central meeting spot, and there isn't a night that goes by when there aren't people staying here late and having an adult beverage and enjoying their self in that space. And what it's caused really, I think, is a case of FOMO for those that aren't here, and so we do have some team members that are working remote, and they miss not being in the office. And so if you can create space that enables you to have that level of interaction, what a great thing. But as a landlord, it's challenging because as soon as a customer wants to reconfigure their space, we've got another challenge, and that is paying for it, and also making certain that we get their business rather than having them move to another building that may have similar services. So certainly it's a dynamic environment right now, and we're dealing with it well, but it's continuing to change and morph.
No, I can only imagine. So clearly office space is one of the asset classes. What are the other asset classes you guys are currently invested in?
Yeah, I would say that I'll start by answering that question with some additional information on our enterprises. We refer to it as. So you have Redico, which is real estate development investment company, and Redico is our commercial real estate company, and it serves as a parent for three other companies that we are owners of. One is American House Senior Living, and American House is a senior housing company that does independent living, assisted living, and memory care, and we are soon to be engaging in the development of active adult communities. We have another company called Continuum, and Continuum is a facility services company And we built that company about 14 years to offer a higher level of services to the buildings that we own and operate. And then we did a good enough job that we were getting requests from third parties, and so it's really a service company that serves building owners. And I think we're about 20% Redico related now. And then during the last recession, we found the need for mechanical room refurbishment in huge facilities, like NASA or like hospitals or Disney. And so we built a company called Aquest, and Aquest is a air quality company that is involved in serving buildings' needs around not only air quality but the refurbishment of mechanical rooms as they start to age. So those are our related companies, and within Redico, we primarily serve the needs of the commercial real estate space. And so what we're doing is we do office, we do medical office, we're in research and development in life sciences, multifamily, active adult, and seniors housing. And so because we're in all of those asset classes, oh, I'm sorry, I didn't include retail. So because we're in all of those asset classes, it suits us well to do mixed use development. And so the benefit of that is that we can be a horizontal land developer, but also we can vertically develop and bring in buildings that we're very much used to investing in and either acquiring and or developing. So we do both the horizontal and vertical development in these large mixed use developments. And so that's an important area of our business. And I'd say that the lion's share of what we're doing today is development, and probably much less in the way of acquisitions.
Got it. And development, I'm assuming, has that been from the beginning, you guys have always been a developer first, or have you acquired pre-built or already occupied operating buildings? Or
Yeah, Redico was always a developer, but from the time that I came in, I've really changed the character of the business. And as I always say to our team here, there's a time to build and there's a time to buy. And I like to buy opportunistically. And so my thought is you buy when there's distress. And so the markets for, let's say, the last 5 years have been pretty dynamic with plenty of capital. And so it's been hard for us to acquire at the types of returns that we generally require. And so we've taken advantage of that time to develop real estate. And I'd say that what's interesting about that is that there are a lot of capital allocators out there, a lot of investors that are in a position to buy, but they don't have the infrastructure, the team that it requires to develop. And so what we've done is we've created a nice niche for ourselves. And the more development we do, we find the economies start to pay off. And so if we're doing 250 to 500 million of development a year, we have the benefit of being able to take advantage of those economies and move teams from one project to the next and benefit through that. And so while construction costs have risen, and one might say it's not necessarily a great time to build, we've found that we were able to successfully deliver a great number of projects. So we're right now developing once again.
And your development efforts, are those primarily located in the same geographic area, or do you have development projects around the country? Or
Yeah, so when I came into the company 20 years ago, we were very much focused on Michigan and primarily Southeast Michigan. And what I learned, throughout my institutional career is that a company that has an element of diversification is well suited for success. And so when I when I left the institutional world, I established a platform that that was geographically diverse and also diverse by asset class. And so when I came into Redico 20 years ago, I pursued the same strategy. And so I would call our strategy historically as being one of opportunistic investing, meaning that, throughout my career, I've invested in probably every market in the U.S. And so we followed that path at Redico, but of recent, we've modified our focus, and our focus has shifted to a strategy that I would say is more concentrated in its geographic focus. And what we have done is we've moved out of our positions in coastal markets by selling assets. And we have very few properties left on the West Coast. We have one, I think, and actually we do have only one in Honolulu right now. We have nothing left in California. We have nothing left in really on the West Coast, but the Hawaii property. But what we did is we felt like with our senior housing business, we needed to maintain a geographic focus. So this business, we bought it about 13 years ago. It was a small mom and pop company. Started with 13 communities in Southeast Michigan. We knew we wanted to grow it, but because it's a heavy operating platform, we felt like we needed to grow it with a strategic focus into what I call adjacent markets. And so we started by expanding our business throughout the state of Michigan, moving into the Midwest, and then moving down to Florida, a market that we were very familiar with, given our ownership of a business in Southwest Florida. And then we moved up the coast. So right now, our senior housing business is focused on the Midwest, moving into New England. We went down to Florida, started in Southwest Florida, moved up the coast of Florida, moved over to the west, from the west coast of Florida to the east coast of Florida, and then moved into Tennessee, and now we're in the Carolinas. So I would say our geographic focus is Midwest, New England, and the Southeast. And the idea is that because we want to be in adjacent markets, we'll connect those markets of the Southeast and New England through investments in the Eastern Seaboard. And there are many reasons for it, but we felt like if we're trying to cover that that geographic territory, that we needed to also shift the Redico focus or the commercial focus into the same markets. And so we're less opportunistic in terms of market identification, market strategy, and I'd say more focused on those markets that I just mentioned.
You mentioned the different asset classes and particularly the senior housing. I'm curious, and you also mentioned how you originally kind of concentrated in Michigan and office. When you were looking for like diversification, you mentioned like expanding the footprint. What were some of the, or what are some of the considerations you look at when considering a new asset class or a new market?
Well, right now, and the reason why we're establishing a serious focus in the Southeast is that the demographics of the Midwest are shifting, and what we're finding is significant growth in the Southeast. We had tremendous success in Florida, riding the wave of population growth, and certainly the wave of an aging population in those markets, and so that was the first criteria. We also had to, and what we have to consider is the ability to source labor. And so demographics play into that as well, because if you have population growth, what you'll have is the potential to source team members in those markets as well. So if people are moving to the Southeast, what we'll have is a greater abundance of human capital, and that's something that's really very important to the companies that we're engaged in. So both in terms of construction, trades, moving up through team members that are physically operating the properties, and then when you're looking at senior housing, and we have about 3,000 employees in that business. When you're looking at senior housing, you're having to source what I call team members underneath three pillars, and that's hospitality or culinary, life enrichment, and then wellness or clinical. And so thinking about it, I need team members that are interested in creating careers in the markets that we're doing business in, and the Southeast seems to serve us quite well there. So so that's certainly a factor. And then I'd say that we follow the traditional real estate principles in that you're looking for markets that have great demand prospects, and so that translate into office jobs, retail uses, customers, if you will, and then certainly living choices. So and I don't think there's any magic to that. I think we all follow demographic trends in real estate well. And the one thing I will tell you, however, about market choices is that we've never been, other than maybe Chicago, we've never been in the primary markets. We look for yield, and so what we're trying to do is define that market, where we can still identify yield opportunities.
Yeah, no, that's definitely important, and I would think that you probably get a little more stability in some of the markets that you're in, as opposed to some of the big swings and some of the more the primary markets and that. I'm curious on your with the senior housing, as a developer and an investment company in real estate, my mind typically goes to, you've got the ground, you've got the vertical structure, and then you've got tenants that are in it. Operational, it's not so much, you may have some facility staff, but not the actual, like the senior housing thing that's pretty much a hands-on, when you've got the restaurants, like you said, the culinary and the health and wellness and all that. Was that a big change for you, or did it present any challenges that you hadn't expected?
It was a monumental shift. I can't tell you, that I've ever come across in my career, at least, a more difficult business to operate in. And I think that's what makes it attractive, is that when you really look around the country at operators, you can count on two hands really the number of really good ones, and it has a lot to do with the way that you manage your business. So it's a heavy operating business, and you've got to attract and retain really great employees, and that's a challenge in a market like we have today, and it was certainly a challenge throughout the pandemic, and so in the response that we've had to our business has been quite good. We have the opportunity to grow the business tremendously, but we intentionally have held back on growth, primarily because we need to be able to serve the residents first and foremost, that we have well. And so size is important, at least as it relates to scale, because we wouldn't be able to retain and attract the best team in the world, in my opinion. In that those are our pillars, on the wellness side, on the clinical side, and on the life enrichment side, and on the culinary side. We wouldn't be able to bring these folks in if our portfolio was too small. And so you couldn't build the kind of infrastructure that you need, I think, to run a business well. too large, and you lose your focus a bit, and you can't provide a personalized service to your residents. But the reason we got into the business was back in, we were in strategic planning in 2007, and we saw some headwinds, and we thought, okay, so we're in the office business, we're in the retail business, we're in the medical business, and we were doing a lot of build-to-suits at the time. What happens when the world comes to an end? When you have a real estate recession like we saw, and our thought was, well, what do we do, to find a recession-proof business? So we looked at a lot of different companies, and senior housing emerged, and then our thought was, okay, this is a heavy operating business, and we came to realize that. So our thought was, well, do we grow the business like we always have, moving into other asset classes, and grow it organically, or do we buy somebody? And so we decided on a combination. So we bought a company, and it was a 45-year-old company, American House, and it was mom and pop. And what we did is we added institutional character to the business and built it to face the needs of a resident population that was changing very rapidly in terms of acuity. And so we went from the original 13 properties, and when we complete everything that we have under development today, we'll have 72 communities, in the markets that I had mentioned. So we built the scale that we needed to. We made the investments in the infrastructure that we needed to be responsive to the needs of the business, and then we continue to morph with the changing needs of our resident population, and they have been changing, and especially throughout the pandemic, they changed. That took a lot out of our employees, but it took a lot out of our residents as well.
No, I can only imagine just the the human capital and just the operational demands of a business like that, as opposed to more of a landlord kind of a business model. That's definitely a night and day kind of difference there. But it sounds like, if you've gone from 13 to 72, sounds like you figured out how to make it work. And
well, we have. It's interesting because the secret to success in the business, and believe me, we have our challenges, and it hasn't all been success. I'd say that that we've done tremendously well in the business, but to any degree that we've had success, I would tell you that it's because of the passion that we all have for the business here internally. And I look at it, and I've said this many times before, and my team members will say the same thing, but if you do it well, you feel as though it's a philanthropic endeavor because you're giving something back. And the way in which you're able to satisfy your residents' needs is just so unbelievably fulfilling if you do it well. And so it's almost philanthropic, and you have to kind of look at the business that way. So it's a different approach than what we've all experienced in real estate. And 40 years of real estate tells me, okay, I'm driving for returns. And in this case, you're driving for returns, but the returns are a little different. It's returns from a humanistic perspective.
yeah, no, that's well put. And you got to have some sort of a profit side of the the equation there, but definitely when you're dealing with people and just the massive amount of people. Would you say 3,000 employees on the one side, and then all of your residents, and that's definitely a little bit more involved. Hey, I'm curious, Dale, are there any emerging trends or anything that you're following or paying a lot of attention to that you believe will influence your near or long-term plans?
Yeah, I'm just kind of a little bit of insight into our strategy going forward. In what we sit as a team and build 3-year business plans, and kind of some insight into my business plan right now is that we're maintaining our geographic focus. We are looking at and considering more in the way of mixed use developments, only because we have the opportunity to capitalize on the horizontal and vertical development, and also take advantage of the skill set that we have in being able to operate various asset classes. What we're focused on now is we're moving from traditional multifamily into single family residential for rent. And so we're looking at single family for, as a rental alternative to ownership. We are also looking at active adult and trying to take advantage of the skill set that we have in multifamily, but also the skill set that we have in senior housing. And so I'd say that is a trend, and we'll probably all hear more about it. But it's a social model attached to a multifamily business that capitalizes on the lives of serving the lives of seniors. So we're looking at that. We continue to do what we've always done, and that's buying land and developing parks where we can do build-to-suits. It's interesting, the trend happens to be, and I'm not sure if this is a trend for us or a trend nationally, but I'd say that, well, I wouldn't be guessing, but every one of our build-to-suit customers has been a foreign company. So that probably would not have been the case 10 years ago. So say in the last 5 years, the build-to-suits that we've done have been for foreign companies, and who's looking at our parks today? They're foreign companies. We don't do much in the way of warehousing. We got out of that business quite some time ago. Probably would have, benefited had I stayed in it, but we saw a lot of that business, going offshore, and with just-in-time delivery, it didn't feel to me like the right business to stay in. And in hindsight, I wish I had stayed in, or I wish I would have gotten back in sooner, because it seems to be a hot commodity right now. But we don't do much warehousing. We do, I'd say, more build-to-suits, and it's more centered around research and development and technology and life science buildings. So those are the trends that we're tracking, and that's really the way in which we're growing our business right now.
Got it. Hey, Dale, if we could, I'd like to shift gears here for a second. By day, I'm an insurance broker, and I work with my clients to assess risk and determine what to do with the risk. And there's 3 strategies we typically consider. We first look to see if there's a way we can avoid the risk. When that's not an option, we look to see if there's a way we can minimize the risk. And when we cannot avoid nor minimize the risk, then we look to see if there's a way we can transfer the risk. And that's what an insurance policy is. And as such, I like to ask my guest if they can look at their own situation. Could be their clients, investors, tenants, the political landscape, market interest rates, however you choose to define it. But if you can take a look and identify what you consider to be the biggest risk, and again, for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance related answer. And so if you're willing, I'd like to ask you, Dale Watchowski, what is the biggest risk?
Yeah, so boy, I could speak on this topic for hours, but I'll start by just offering a general thought, and it's nothing that that I'm sure your listeners haven't heard already and know very well, but risk is inherent in our business. Being in the real estate business as an investor is we're no strangers to risk, and as developers, I'm part of a pretty optimistic lot, and I think you probably heard it said before that you have to be a dreamer and you have to be a very an optimist to be a developer, and I would say that I'm probably the exact opposite of that. So I tend to focus on the downside, and my team here has to always temper that, because I'm always pointing out the risks inherent in everything that we do. But But I'd say that, speaking outside of, the risk inherent in, that inherent in the insurance industry, I'm gonna go to kind of market risks right now, and I'm going to tell you that to our conversation earlier, my biggest concern is around our office users, and are we going to be able to retain them? Will we go back to the office? What form will we go back to the office in? What's it going to cost me, to build out space that is attractive to my office users? And what do we do during this time of transition? When your users are only looking to renew on a short-term basis, which is really what's happening right now. So what the impact of all of that might be is that capital is becoming much less scarce, for office owners and developers, and because the capital markets are pricing in the risk inherent in that business, and so I see the availability of capital, playing in significantly into the office market, and so I also see on the residential side. I'm going to move to another area of our business, and this translates into both our market rate, traditional multifamily users, of any age, right through a multi-generational platform that will include senior housing, but affordability is a major factor. And while we were not acquiring bundles of properties, in multifamily, over the course of the last 5 years, we certainly were looking at, the trades that were being done out there. And what had happened is we took an affordable stock, and we said, okay, we're gonna improve a kitchen, or we're gonna improve the common areas, and what we're gonna do is we're gonna increase the rent by 20%. Okay, and now you factor in inflation, and what's that going to do to the housing stock that's out there that would have otherwise been affordable? And then the other factor is, how are we going to build housing that that our tenants can afford, given inflationary pressures. So I'd say that there's a lot of pressure on the residential space, in that we're going to have to be responsive to the needs of the general population, which is, how do I afford to live? And maybe that's why multifamily or rental housing is so attractive, and probably the reason why we're looking at single family rentals, as an alternative to single family ownership. And so, what I see, as a trend right now, and this is intergenerational, is that people are underemployed, and so that'll probably change. But then, kind of moving over to the senior space, what I've seen as a trend is that many of the boomers throughout this recession, or throughout the pandemic, by the way, I happen to believe that we're probably in a recession right now, but at least the real estate recession. But that said, many of the boomers have retired, or they've left the workforce, and then those same boomers that we're trying to attract into our senior business, they're not like the greatest generation, the World War II generation. They don't have savings, they don't have equity in their homes, they don't have pensions, and they don't have 401ks. Which is what really drove our business and enabled us to maintain occupancy levels, over the course of the last 10 years. So we have very few of those residents left, and very few of our residents now, have the kind of money that they would need to move into one of our properties. So what's happening is that they're moving in on a need-driven basis, and they're moving in at, 85 rather than 75, which is where they were 13 years ago when I came into the business. And so, and because of that, they have more health needs. So we have to find employees to serve their needs. Okay, and those employees aren't out there. So how do you mitigate that risk? And I think you mitigate the risk by trying to play in the middle markets and build a product that's affordable. You try to not just attract and pay your employees well, but you try to retain them by by offering them a great, work environment. And then what you're going to have to look for is a way in which to retain your tenants even after they don't have the ability to pay any longer. And so we're looking for different forms of assistance to bring into our business. So a lot of factors play into this, and I think I could, as I said, I could talk about it for an awful long time, and that doesn't even bring up the risks that we have today that present themselves, as a result of geopolitical pressure and the environment that we're dealing with. As we started our conversation before this call, the environment that we're dealing with is one that's quite obvious through the heat that we're incurring right now, and the fact that we have to keep these buildings running well throughout extreme temperatures. So there are a lot of challenges. I think you hit on an interesting topic.
Well, I appreciate all your perspective there, because like I said, risk runs far and wide. It's 24/7, and I always appreciate my guest input on what they're facing, and clearly there's plenty of risk for you to keep you up at night there. So I appreciate you sharing that. Hey, Dale, where can the listeners go if they'd like to learn more or connect with you?
Well, we have, first of all, I'd love for listeners to reach out to me, and my email address is dwatchowski@redico.com, and that's WATCHOWSKI @Redico, REDICO.com. My office number, and I'll give that to you, is 248-784-6504. So send me an email or call my office. But I would also suggest that you visit our websites, and they're easy to find: Redico or American House or Continuum Services. And I'm available for you, and love to further chat, and hopefully it's not all around risk, but about opportunity. So.
All right. Well, Dale, I cannot say thanks enough for taking the time to talk today. I've thoroughly enjoyed it, learned a lot, and look forward to doing it again soon.
My pleasure, Darren. Thank you.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CRE PN Radio.